Right now, over $500 billion is being traded, not by governments, not by banks, by ordinary people, sitting at home just like you. Most of those people have never asked the most basic question of all. What even is the stock market? They just opened an app, saw numbers going up, and started trading. That is like jumping into a Formula One car without knowing what a steering wheel does. Most beginners just click buttons and hope. This video changes that forever. By the end, you will understand what the stock market is, how it works, who controls it, and the mistakes that destroy most beginners. No jargon, just simple explanations that make sense. Let's go. Let's start from zero. Imagine a giant marketplace, like a farmer's market, but instead of tomatoes and bread, people are buying and selling tiny pieces of companies. A company is just people working together to make money. It could be a small coffee shop or the largest technology company in the world. A stock is a tiny piece of ownership in a company. One stock equals one tiny piece of that business. If Apple is worth $3 trillion and split into 15 billion pieces, each piece is one stock. You buy one, you own a tiny slice of Apple. You're not buying a number on a screen. You're buying actual ownership. If Apple grows, your piece becomes more valuable. If Apple struggles, your piece loses value. People care about which stocks they own because they are betting on the future success of real businesses. The stock market is simply where millions of people come together every day to buy and sell these pieces. Think of it like eBay, but instead of secondhand shoes, people are trading ownership of companies worth billions. It's a marketplace, buyers and sellers, supply and demand, nothing more. Why would a company sell pieces of itself? You want to open a pizza restaurant. You need $100,000, but you only have $10,000. Option 1, borrow from a bank. You get the money, but you owe it back plus interest every single month, whether business is good or bad. Option 2, sell pieces to 10 friends for $10,000 each. Now you have your 100,000. Your friends own 10% each. If the restaurant does well, they share the profits. No monthly debt crushing you. Most smart business owners choose option 2. That is exactly what companies do, but instead of 10 friends, they sell to millions of people. Tesla, Amazon, Microsoft. This process is called an IPO, an initial public offering, the day a company opens to public investment. When a company does an IPO, billions of dollars change hands in a single day. Employees who worked for years suddenly become millionaires. For ordinary investors, an IPO is an opportunity to get in early on a company you believe in. After the IPO, shares keep trading every day. People buy and sell between each other. The company is not involved, like reselling tickets after a concert. Why does a stock price go up or down? Most beginners imagine huge formulas and economic models, but the real answer is much simpler. One word: perception. Price moves based on what people believe will happen next. If people believe a company will be worth more, they buy now. More buyers than sellers. Price goes up. If people believe a company is in trouble, everyone sells. More sellers than buyers. Price goes down. A company can report record profits and its price can still fall because investors were expecting even bigger profits. Belief did not match reality, so they sold. Think of a popular restaurant. Everyone loves it, it gets packed every night. Now imagine a food poisoning scare. Doesn't matter if it's true. The moment people believe there's a problem, the restaurant empties instantly. The stock market is millions of people voting with their money every single second. Once you understand what drives those votes, you see the market completely differently. The stock market has two very different types of players. Player 1, retail traders. That's you and me, ordinary people trading from home. We make up about 20% of daily volume. Player 2, institutional traders. Banks, hedge funds, pension funds. These are the whales. They move hundreds of millions, sometimes billions in a single trade. They make up 80% of daily volume. When a whale moves, the water moves. When they buy, prices jump. When they sell, prices crash. Profitable traders don't try to predict the market. They watch where the big money is going and follow it. Fighting against institutional money is like trying to stop a wave with your hands. It's the difference between swimming with the current and being swept away by it. What makes a good stock versus a bad stock? There are two schools of thought. Every trader falls into one of them. School 1, fundamental analysis. looking at the company itself. Is this actually a good business? Fundamental analysts check, is the company profitable? Is revenue growing? How much debt? Does it have a competitive advantage? Who's running it? Warren Buffett lives in this world. He doesn't buy stocks, he buys businesses. He wants to understand the company so deeply he could run it himself. Fundamental analysis is powerful for long-term investing. Find a great company at a fair price and hold it for years. The market rewards you. School 2, technical analysis. Technical analysts don't care about the company. They just look at the chart. They study price patterns, support and resistance, volume, momentum. Everything is already reflected in the price. Day traders and swing traders live here. They might buy in the morning and sell by the afternoon. They want to know, is this a good trade right now? Most professional traders use both. Fundamentals help you choose which road to drive on. Technical analysis teaches you how to drive the car. You could be on the best road in the world, but if you can't drive, you'll still crash. For beginners, start with technicals. Learn to read a chart first. That foundation serves you in every style of trading for the rest of your life. The 3 biggest mistakes every beginner makes. Most people learn these by losing money. You're learning them free right now. Mistake 1, trading with money you can't afford to lose. The stock market is not a savings account. Losses are completely normal. Never trade rent money. Never trade bill money. Only trade money you're completely okay losing. Every professional trader loses regularly. The difference is they manage losses carefully and make sure wins are bigger. When you trade scared money, emotions take over. You hold losing trades too long. You exit winning trades too early. Pressure destroys judgment. Start small. Your goal is not to make money yet. It's to learn without getting destroyed. Mistake 2, following tips without understanding why. Buy this stock. Trust me, it's going to the moon. You'll hear this on social media, from friends, in WhatsApp groups, in YouTube comments. Someone always has a hot tip. If you don't understand why a trade makes sense, you have no idea when to exit. When the trade goes against you, you freeze. You hold, you hope, and that's where accounts get destroyed. Only take trades you understand completely. If you can't explain why you're entering, you're not ready. Mistake 3 is expecting to get rich fast. Turn 1,000 into 100,000 in 6 months. Quit your job, buy a Lamborghini. Almost entirely fantasy. And chasing that fantasy wipes out beginner accounts faster than anything else. Real wealth is built slowly and consistently. 1% per day compounded turns $1,000 into $37 million in 1 year. Small, consistent gains compounded over time create extraordinary results. Greed destroys accounts. Patience builds them. The market will always be there tomorrow. The goal is to still be in the game next year, not to retire next month. Let's recap what you now know. The stock market is a marketplace where millions of people buy and sell tiny pieces of companies. Every piece connects you to a real business with real products and real revenues. Price moves based on belief, not just reality. Human emotion drives every tick up and every tick down. There are 2 types of players, retail traders at 20% and institutional whales at 80%. Understanding their footprints is one of the most powerful edges you can develop. 2 ways to analyze stocks, fundamentals and technicals. Smart traders use both. Beginners start with the chart. And you now know the 3 mistakes: scared money, blind tips, and the get-rich-fast fantasy. That's a genuine foundation. Most people trading for months don't have this clarity. In the next video, we look at the one tool every single trader uses every single day, no matter what market or strategy. It's called a candlestick chart. Every candle tells you a story. Who's winning, the buyers or the sellers? Fear, greed, momentum, and reversal. Most beginners see nothing but noise. By the end of the next video, you'll read it like a book. Candlestick charts explained, what every candle is telling you. That's exactly what I'm covering next. Hit subscribe right now and like this video so the algorithm shows it to you the moment it drops. See you in that one.